If 20% of the world's energy is going through the Strait of Hormuz, in this case, we think the regime in Iran is feeling much more existentially threatened and might be more tempted to truly retaliate in a way that does inflict pain on American consumers and on President Trump and his administration.
Were you surprised to see such a strong sell-off on Wall Street, given the president's conviction that the big picture when it comes to tariffs won't change that much as a result of the US Supreme Court ruling?
Yeah, I think there's probably more going on in the equity market lately than just the tariffs. We obviously have this rotation. A lot of investors increasingly skeptical about when, if ever, returns will be generated on capital expenditures into AI. So I tend to think what you're seeing is more of that rotation. I don't believe the tariff news was really much of a surprise. Most of us did expect that the Supreme Court would rule that IEEPA was not a legal basis for tariffs. And we also expected that President Trump would immediately respond by invoking Section 122 to impose new tariffs. So I don't think it was largely driven by the tariffs in this case, probably more rotation.
Okay. Do you see investors leaving the US? Are US investors, not just global investors, starting to look further afield?
Well, I think over the last 18 months, and again, I say 18 months to say predating the current Trump administration, a lot of investors globally were starting to worry that they just had too much capital in the United States from a risk management perspective. If you look at the MSCI All Country World Index, the U.S. represented as much as 64% of the weight of the index. The number 2 country was Japan at like 5%. And so I think a lot of investors were already a bit nervous. Then last year you had the trade war, you had the U.S. dollar depreciate by double digits. And so I do think you are definitely seeing more investors outside of the U.S. pulling back a bit of their capital and saying, okay, do I want as much in U.S. equities, as much in U.S. bonds? In many cases, they're afraid to sell their U.S. equities because they don't want to miss out on the AI trade. There's the FOMO, fear of missing out. But some of them are dialing up their currency hedges to have less U.S. dollar exposure. In the U.S., a little less of that, but outside of the U.S., definitely seeing more interest in non-U.S. equities, in emerging market equities and Japanese equities in particular.
Are US investors starting to question the US economic outlook and whether those interest rate cuts that the president so dearly wants are going to happen?
Well, let's take that into 2 parts. On the economic outlook, it's been really interesting. If I just watch Bloomberg consensus expectations, at the beginning of the year, the expectation was the US would grow 2% in terms of real GDP this year. As of today, it's 2.5%. So people have gotten more optimistic on GDP, I think largely because we've gotten all of the announcements from the hyperscalers of even bigger capex into AI. And if you look, going from 400 billion to 700 billion is 1% of US GDP. So that could increase the GDP growth. But the interest rate cuts are becoming a bit more problematic. The market is still saying we'll get 2 25 basis point rate cuts by the end of the year. I think that's looking more in question. Yes, we have Kevin Warsh as the nominee to be the new chair of the Federal Reserve, but he's only one of 12 voters on the Federal Open Market Committee. I think it's going to be hard to convince his fellow members to vote for rate cuts in a full employment economy with inflation running above the target.
How concerned are investors about the possibility of a US strike or indeed a greater military confrontation with Iran as early as this weekend?
Well, I think markets in general, not just US, but globally, have kind of learned a lesson, you might say, over recent years, that if you just look through geopolitics and ignore it, it'll all be fine. Think about the 12-day war last year. Brent crude oil prices went up 10% for a couple of weeks, and then they went right back down. And so I think people suspect that you really shouldn't trade around these things or change your asset allocation. But we think that's a mistake. We think in this case, it's highly likely the United States will attack Iran in the next few weeks. And we think the probability of Iran retaliating in a more serious way than they did last year. Last year, it was all symbolic. They fired missiles at a U.S. military base in Qatar, but they warned the U.S. before they fired them. This year, we think they will genuinely retaliate, and that there's a much higher risk that they might impair the flow of crude oil and LNG through the Strait of Hormuz. That's 20% of the world's energy supplies every day. That could be a very meaningful mover for markets.
Okay, and so if indeed the forecasts of a hot war do come true, what else do you see happening in terms of financial markets in the coming weeks and months?
Well, I think the big thing to watch is if the U.S. attacks Iran and nothing happens to energy supplies, it will be another non-event for markets, right? Markets only care if it's going to move the price of commodities or interest rates or something else. But again, if 20% of the world's energy is going through the Strait of Hormuz, In this case, we think the regime in Iran is feeling much more existentially threatened and might be more tempted to truly retaliate in a way that does inflict pain on American consumers and on President Trump and his administration. That would be by mining the strait or using drones or other weapons in the Strait of Hormuz. Beyond that, I think the big topics we all have to look at are sustainability of the AI capex boom, whether this rotation within the U.S. equity market turns into a rotation of capital out of U.S. equities full stop into other markets. I think that would be a wise choice for many investors to reconsider allocating more outside of the U.S. But there are going to be plenty of geopolitical and economic questions for us to ponder through the rest of the year. But right now, the key ones are Iran and AI.
One final question for you. The US and China, they're at a very delicate stage of trade negotiations. The US president is due to visit President Xi in about a month or so from now. Given everything that you've just told me, what are the implications for those talks?
Well, I can say for the U.S. administration, they have a very high priority right now on not antagonizing China in advance of that visit. The president really wants to get a deal with the Chinese. And basically, it seems very clear that the administration has directed U.S. government agencies not to make the Chinese angry in any way through prohibitions on trade or other sanctions. Having said that, with the Supreme Court ruling at the end of last week, that arguably has also made the U.S. negotiating position a bit tougher, because in the past, the president was able to use this International Emergency Economic Powers Act quite unpredictably on any given day to say, well, then I'm going to double your tariff. That's not possible anymore without using IEEPA, because the other legal codes that allow tariffs require process. And so I think it will make the negotiations probably more challenging for the U.S. side. And I would argue, even coming into this, the Chinese had the upper hand in the negotiations, because they've clearly demonstrated last year that they have leverage over the West through critical earth and critical minerals and rare earths, and they're willing to use that leverage. And let's be honest, in many supply chains across many industries, China has critical components that are hard to replace on short notice. So I do think the Chinese entered this from a strong negotiating position and likely have an even stronger one now.
Ronald Temple, thank you.
Thank you.